Now, throughout the discussion of investments and even a number of other maybe conversations that we've had, we keep on chatting about this term fair value. Fair value in accounting is simply the transaction price between a willing buyer and seller in a non-distressed market that would be a fair price and a price that market participants, not just one person, but market participants would be willing to buy the security. Whatever price that is, that's the price they'd be willing to buy the security. So the focal point is on market participants. We pay close attention to what do market participants think is the fair value. Now, there are 3 different levels of fair value that you can have. Level 1, and you can probably think what the other 2 levels are. You're right. Level 2 and level 3. So what do these levels mean? Well, a level 1 uses what we refer to as a market approach only. Right? Total market approach. A level it is a security that you have, any kind of fair value that you have is a level 1 fair value if, using a market approach, you have identical assets trading in an active market. Okay? So what we mean by a market approach, we're going to go into the market, New York Stock Exchange, NASDAQ, debt markets, whatever it is, and we find the exact asset. So we wanted to figure out what the level 1 fair value of Apple stock is. We'd go on to Bloomberg or the Wall Street Journal or whatever, and we'd find other shares of Apple that are trading. Those are identical assets, identical securities, and we would get whatever the price is at the end of that day, and that is an active market, and those are identical assets that are trading in that active market. That's a level 1 fair value. And there's not a lot of risk around that as far as the estimate of fair value. Because everyone can agree, because it's an active market, that fair value should be about this. Plus or minus a small amount of money, right? Small, whatever that small amount of money is. A level 2 is I can either use a market approach, where I'm looking at similar assets traded in an active market. Or I can use an income approach, where I'm using income data to value the asset. And this income data might be cash flows, could be a variety of different variables, right? So an income approach versus a market approach. The reason why it's level 2 is because any of the inputs, either to the market approach or to the income approach, all the inputs to coming up with these values are all observable by market participants. I'm going to abbreviate that MP, by market participants, these people. Right? A level 3 is, same thing, I can use the market approach. Similar assets traded in an active market, or the income approach. I can use either one. The reason why it's level 3 is because here the inputs are not observable by market participants. Right? And so, as a reader of the financial statements, if I'm looking at an investment portfolio, or I'm looking at any of their fair value calculations, I look to see how much of their stuff is level 1 versus level 2 versus level 3, because this tells me of those assets that they have on their balance sheet. What is the riskiness, right? What's the plus or minus? What's the variability around those fair value estimates? So if it's level 1, I know that the variance is probably small. Level 2, well, I'm not getting identical assets, I'm getting similar assets, but at least the information is observable by market participants, so maybe the variance is clearly bigger than level 1, but at least it's using available observable data. When I get to level 3, I'm making this stuff up by myself, right? The market participants, I'm creating this fair value. It's not using observable data. And so as as somebody looking at the financial statements, the variance around that fair value could be really wide. So as you look at risk profiling a company, level 1, and I look at that number, active market, identical assets, not a lot of up and down risk, right? Level 2, a little bit more, right? Because it's not the identical assets, it's similar assets. So, but at least the data is observable, so there's less variability there. Then level 3, which is we don't know, could be much higher, could be much lower than what they're telling us, and that variance might make me uncomfortable. So this kind of tells you, level 1, level 2, level 3, what kind of risk, as far as the value of those assets, what's the riskiness of those assets.